Okay, so hello everyone, and thank you for being here tonight. So this evening, the CCS Trainee Networking Working Group is proud to present you its highly anticipated event, MD Finance 101. So my name is Ahmad Al Samarai. I'm a PGY2 in internal medicine at University of Montreal, and I'll be one of the moderators tonight for this event with Shamira Samuels. Shamira?
Hello, everyone. My name is Shamira Samuels. It's a pleasure to be co-host of this remarkable event, joined by my colleague, Ahmed. I'm currently an M1 at Queen's University, enrolled through the Currents pathway, and my passion lies in the realm of cardiology.
So we're truly honored to have a selection of cardiologists and cardiac surgeons from coast to coast who have generously responded to our invitation. So our panelists are Dr. Daisy Dulay, a cardiologist and clinical assistant professor at UBC. We also have Dr. Iqbal Jaffer, a cardiac surgeon at McMaster University.
Our other panelists also include Dr. Shekhar Pandey, a cardiologist at Cambridge Memorial Hospital and founder of Cambridge Cardiac Care Center. And finally, Dr. Atul Jaitka, a cardiologist who recently graduated from Western and is now completing a fellowship in echo at Toronto General Hospital. So basically, the first part of this event will consist of questions and answers with our panelists, and then we will end the evening with networking.
So before proceeding, we'd like to thank our highly valued financial partners, RBC and TD Bank, who provide our CCS members with esteemed financial and insurance advice. So when we'll be in the networking part, the second part of the event, you will see their logos at the top of the page next to the CCS logo. So you will be able to click on our partners' logos on the floor plan to have more information about their program. So now let's start with our first question with Dr. Dulay. Hi, Dr. Dulay.
Hi, everybody. Thanks for the invite.
No problem. So the first question, Dr. Dulay, that we would like to ask you in regard to finance is, how do I save for my retirement as a self-employed physician?
I think the earlier you start thinking about it, the better. For me personally, I can speak to my own experience. It was something that I started thinking about much earlier as a resident when I finally was able to make some money and tried to save money during residency, which is a bit challenging given the circumstances of today with inflation, what have you. But trying to save as much as I could. Even during residency, I would put away things at the time, which was only available as RSPs, but now we have, the TFSAs as well as the home savings. I forget the acronym for that, but the whole point is to really start thinking about what is your financial goals, and for everyone it is different, right? It's kind of like your personal self-care. I actually think of financial well-being the same as part of the well-being generally as well, because you want to think about how your spending habits are, what your your background is from. Like, for example, I'm a first generation physician, so coming to a point where finances were stressed when I was a kid, that impacts the way I make decisions in savings, for example. So knowing how you spend, or your spending habits, really will affect your retirement plans as well. And I think the other pieces around that is, are you thinking about high, low, medium, intermediate risk? Do you want to take over control of your retirement plan, or do you want to have someone else help you through that? I think those are the important questions. The other one is vitally important is, what are your partner's financial goals, if you have one, because that's also equally important. And how aligned are they? And whether or not you are going to share those, the financial life together, if you want to say that. Like, for example, I have to think about my husband, who's American. We actually have to have separate accounts, because otherwise my income would be taxed in the US as well. So there's little things like that you have to be aware of, and being financially savvy is scary, but I think it is really important to have that education, and seeking that information and not relying just on someone else. Also having that information is also equally vital. I think the other thing I would say is, like, when we're thinking about saving for retirement, you do really need to think about that when you're ready to incorporate. That is a discussion with your accountant, but for many of us my colleagues and I, corporations are our vehicle for retirement. But in some places, like in British Columbia where I practice, our medical association has negotiated with our government through the Ministry of Health, through our master's agreement, to have RSP contributions. So it depends on how many years you've been there. So, like, for example, this year they will contribute for practicing physicians up to $9,000 a year. They used to make you do a equal contribution, but that has been removed, and you can either choose to do it in RSPs or TFSAs. So again, it depends. So you want to look at what do the medical associations offer for retirement plans as well. And the other one is where you can have, and I don't know much about that, so I would lean on to my other colleagues who might know more about this with regards to, an individual pension plan, which I do not have, and I cannot speak to that piece. But yeah, I think those are the starting pieces that I would say. I think a lot of what I've learned is through my worldviews and culturally being brought up in a frugal environment. And so one of the things that I learned was saving for retirement. It's never too early.
Very good. Thank you very much, Dr. Julie.
Yes, thank you, Dr. Julie. I really enjoyed what you said about considering, like, our partners' situations and just looking at it holistically. So the next question I have is for Dr. Jaffer. How are you today?
I'm good. It's been a nice day today.
I'm glad. So my question is, I'm wondering, how did you integrate student debt repayment into your financial plan as a trainee and in your early career as a physician?
So that's a good one. I have a lot because I went overseas for medical school. So I think I have more than the average as well. And so the real key is to just not be overwhelmed by the large number and just to kind of chip away at it. And I think that, as with retirement, it's a thing that you just need to make a priority. So you really just try to, as a resident, it was challenging for us because we also had children during residency. So their needs to also stay alive were ahead of our need to pay down our debt. And so really we started when we were both kind of on staff. My wife is also a physician, and so once we were kind of clearing the children's bills and our regular bills, that's when we really started to chip away at stuff. I think the value of having the lines of credit, in interest only mode, give you a little bit of flexibility. And then as you finish, they go into repayment modes. But again, those are things that you can negotiate with your bank to try and give you some flexibility as well. But the key is, as the wealthy barber says, is to pay yourself first. And so if you set aside money every month and treat it like money that's going into your pocket as you start to chip away at your large numbers, that's really how we went about it. So every month we set an automatic payment into our lines of credit to try and to work that down. The other thing that we did was, when we had line of credit room, and we also had like OSAP loans and such, the line of credits rates were much better than the OSAP rates. So we used the room in the line of credit to pay down our OSAP completely, cleared that, and then just worked on the line of credit. So that's kind of how we went about it.
Very good. Thank you, Dr. Jaffer. It's really Yes, you taught us resiliency through that. Through that, you know, you had your children, and you also had to pay all your debts coming overseas. So thank you for your answer. Now moving on to Dr. Pandy. Hi, Dr. Pandy. So my question for you is, should we do our billing ourselves or through a medical billing service, and why?
Yeah. Yeah. So, that's a very good question. I think it really depends on multiple things. It depends on what type of practice you have, what type of environment you're in, and what your sources of billing income are. So, for people that are in academic practice, the group billing cycles will handle much of that. For people that are in private practice, again, it just depends on what are your sources of income. If all of your work is in your own clinic, it's relatively contained. That's one side of thing. Many cardiologists, work in different capacities. So, for example, I work in my own clinic, but I also work at the hospital. I do nuclear, studies at the hospital, but I also do it at a private lab out of hospital. I do echoes at the hospital, but also at my clinic. And so there's various places in which I'm doing work. Some of them do the billings themselves and then will pay me the professional component. Others, I'm responsible for billing. It gets complicated to keep track of it. I think one of the key things is to make sure either you're really savvy at being a good bookkeeper or have a good bookkeeper. You don't want to be working for free. And, we work really hard, and it's easy to have, just get focused on your work, see the patients, work hard, assume that everything is going to, work its way out and that you're getting paid for the work you're doing. Nobody should work for free. I'm a firm believer that we work hard and we should be remunerated for the hard work we do. But those things can very much fall through the cracks, particularly if there's multiple lines of revenue. So having a good bookkeeper, I think, is essential. If you're yourself not savvy enough or you don't have enough time, like I couldn't possibly keep track of it. I just am not savvy enough with accounting. So one of the first things that was important for me was to have a good bookkeeper. In terms of, whether you do the billings yourself, a lot of office-based EMRs, for example, have integrated billing within them. And so certainly the more control you have, the more likely that things aren't going to fall through the cracks. And so for all of the patients that I see, for example, in the clinic, our EMR is set up so that at the end of the visit, I know what I've done, how much time I spent, what value I brought to that visit. It was a very quick 2-minute renewal of medications review. Then, it could be a quick partial assessment. You don't want to overbill. You want to make sure you're billing appropriately, but you also don't want to underbill. If you spent, it was meant to be a 5-minute conversation, and it turned out that since last time you saw them, they were admitted to hospital and X, Y, and Z happened, and suddenly a 5-minute appointment turned into a half-hour appointment, then that's something, that you need to make sure you capture appropriately. And sometimes if you're able to do your billing yourself, the value that you've brought to it. So, some of the EMRs certainly allow for that self-billing. But then there are other aspects of things that I do. For example, when I'm reading echoes or, doing nuclear studies and things like that, I couldn't possibly handle that type of billing. And so then, having someone else involved. So I think it really depends. There's so many different streams of revenue that as a cardiologist that we often have coming into it, that having a broad approach to it. And as your career evolves, your practice evolves, it grows, your needs for support will continue to grow.
Thank you for your response. That was very elaborate, and I think you brought up very many significant points that everyone should consider. The next question I have is for Dr. Jedka. How are you today?
I'm doing well. How are you?
Thank you. So my question is, what specific financial tips do you wish you knew coming into residency?
Well, the first thing for billing, I did my first locums a few months ago, and definitely take some time. Like in your day to actually bill, it took a lot longer to do hospital billing than I would have anticipated. It's a huge pain, but I think jumping off of the billing and kind of how I've kind of figured it out. I think the most important thing is you need to find people the same way you find clinical mentors, you need to find financial mentors. I think that's the most important thing. There isn't really great books. There's some books that are, general financial literacy, but there's a lot of different things specifically for medicine, and then even then in medicine, internal medicine and cardiology, that you don't learn from anywhere. So you have to find those mentors in your institutions. And I think now it's becoming more popular to talk about, billing. I think when I first started, you didn't staff kind of build secretly. They had their little cards, but now their staff are very upfront. I mean, they have their billing cards, and if you ask them, they will show you what they're writing on their billing card. So I think the most important thing is that you need to actively seek financial mentors. I remember when I first started residency, like your financial mentors were these groups of like these financial companies that would come do seminars for med students and residents, and that's where you'd be learning from, and then you'd kind of be talking to peers. But if I was an R1 now, I would be doing is reaching out to R4s, R5s, fellows, and then early staff to talk to them. What should I be anticipating? What do I need to know? Because that's where now that I'm a kind of a clinical fellow, I was having a lot more productive conversations as an R5, R6, because people just above me knew a lot more financial tips that were more relevant. Whereas as an early resident, you're a lot more in the dark. You don't know staff, so it was a bit trickier. Another kind of a few specific resources that I think everyone should know about, kind of figuring on kind of the mentorship, is one. It's kind of ironic. It's a Facebook group, but if everyone doesn't know about physician financial independence, you should join that group now. It's the only reason I have Facebook. I would have deleted it years ago. I just have one group that I go to. It's this one group, and essentially, you can imagine it. All of your senior or colleagues having financial chats. And then you can also ask questions, but really, like, I just learned so much from absorbing what other people are saying, what other people are going through. One of the things that is kind of embarrassing for me and my wife that came up recently, that we didn't really know what our monthly spend was. Like, we had general senses, but then we didn't really know what a normal monthly spend is. Like, what two physicians with two kids, like what in Toronto, like what should we be spending? Like what is normal, what is average? And it's kind of helpful. I mean, there's tons of posts of people saying, this is my monthly spend, this is what I'm spending on mortgage, this is what I'm spending on this. So you can kind of find those kind of people that are near to you, which you wouldn't bump into necessarily in real life. So I think that's really helpful. The other kind of specific resource, there's a blog called Looney Doctor, which is also it's a internist who this is how I started my RESP. I just went Looney Doctor had a great RESP post, and I started the RESP for both my kids. And he has kind of these like mathematical modeling, and I just kind of followed what he did. It seemed very reasonable. I checked in the Facebook group, and I'm like, this all seems reasonable, and cross-checked that with friends, and then you kind of can do a lot of investing and financial stuff by yourself. So I think I'll leave it there, but just to summarize, try to find kind of mentors, in the few years above you, and figure out what they're doing now to kind of set up their financial wellness, and then just keep a Facebook account for one group, essentially.
Can go ahead, Shimar.
Thank you for that, Dr. Jaka. I really appreciated your response. So the next question is actually for Dr. Dulé. So I wanted to ask, what are common financial mistakes or pitfalls to be aware of and avoid when starting a career?
I think the first part would be making sure that if you have a potential job offer, get it in writing. And I speak from experience where that did not happen for me in the 2008 financial crisis. When retirements changed, I had a job lined up, and I'm not going to indicate where, but What happened was I was doing an extra fellowship for that, and halfway through that, I got an email saying, we no longer need your services. Things have changed. And I had to scramble, which was a lot harder to do than with regards to trying to find a job within less than 6 months. And it was really stressful. So that's the first thing I would say, is making sure that you have some sort of contract to rely on, and making sure you read that contract, because, for example, are there things like non-disclosure agreements, which may or may not be, for example, enforceable, but people will try to do that. The other thing is to ensure that you have adequate insurance. People don't think about this piece, but it is such a crucial piece. Do you have enough insurance, disability insurance? Do you have critical illness insurance? Do you have overhead insurance? All these things matter. And the younger you get it, the cheaper it is. So that is, those considerations as well. From my early experiences in a community-based practice was that making sure your staff have contracts. They can, if you don't have contracts, it can be a costly mistake. And Atul talked about the, the physician financial independent group, the Facebook group. I've learned a lot of business practice from that group too, and learned, the horror stories of not having contracts and the costs around that too. So again, those are the things that we don't get the practical learnings during our training, but I would really refer to that Facebook group, but also, as mentioned, mentors to have those discussions. And lastly, some of the medical associations, and I'm going to put this in the chat, which is our medical association in BC has how to start your practice. And there's all these considerations. I'm not going to go into details, but please have a look. It is available, and you don't need to log in for that, but it is, practical considerations of things like, IT, how do you create, get that contract, or even basic contracts with your privacy contracts with your staff, for example, because all of this matters, because at the end of the day, you are the one holding the bag. And, the other expenses Dr. Pandy was talking about was around, if you have electrodiagnostics, those are costly things sometimes. In BC, we don't have echoes as outpatients. They're all in hospital situations, so we don't have that expense. But, things like ECGs, Holters, all that does carry some carrying costs, and having staff that are specialized in that and knowing what the market value is. You need to be savvy, but again, speaking to your mentors will be critical in knowing those pieces as well.
Thank you very much, Dr. Dulé. Thank you for sharing your personal experience with having everything in writing. I think that's very important for all of us who are mostly still trainees and students. Now on to Dr. Jaffer with, I think, an important question for everyone. Should I incorporate my medical practice as a physician? What are the pros and cons? And what is the best timing to incorporate?
So that's a great question. And it's a question that comes up early as you're getting close to finishing, but it also comes up in the first few years. And truly, the thing that matters is what's important for your household and how you intend to manage that. So the whole purpose of a corporation is to retain earnings, okay? Is to take a very large amount of money that you're going to all of a sudden make, and then keep some of it and pay yourself a salary out of it. Now, it is double taxation, but because the corporate tax rate is a lot less than the personal tax rate, it allows you to retain earnings and create that as a nest egg for your retirement. Now, the reasons to incorporate are that you make way more money than you need, all right? Or you are in a imbalance situation with a physician partner. Now, in the past, if you had a spouse, you could income split with your spouse. They took that away a few years back. But if you have a physician spouse and you're jointly incorporated, as an example, and you have an income disparity, one person makes $1 million and the other person makes $100,000. Now, if you want to pay the one that makes $100,000 a little bit more, then you can do that with sort of income sharing through a joint corporation. That's one strategy that you could employ to kind of income split. The other things you can do is you can have you can create a trust and such out of a corporation that allows you to manage money for your children in different ways as well. There are all sorts of fancy accounting tricks that that a very good accountant can help you set up. The cons of incorporation, and it doesn't seem like there should be many, but the cons of incorporation are is if you're going to take out all of your money. And if you are initially, as I talked about in my previous question, if you're going to go into debt repayment mode and you're going to take away all the money that you make, then you're getting double taxed. So the real only advantage of a corporation is retained earnings. Okay. If you're not going to take all the money that you make, then a corporation helps. If you do take all the money that you need, let's go back to our $1 million number. And I don't want anybody here to think that I make $1 million. I do not make $1 million. Okay, so let's just, but it's a nice round number for people to think about. If you make $1 million and you need to spend $1 million, as an example, then if you took it all as salary, beyond a certain threshold, you would be taxed at almost 53 cents on the dollar. Okay, but with a corporation, you can pay yourself dividends, and dividends are taxed separately. The benefit of salary is that you get RRSP credit. The benefit of dividend is you get taxed less. So again, a savvy accountant is going to work out a balance for you that maximizes your RRSP contribution room, but also minimizes your tax. It's another one of these flexibilities that you get out of a corporation. So truly, those are, I think, the pros and cons. The pros are it's a little bit more flexibility with your money, but it's also an opportunity to retain earnings and build your retirement. The cons are if you need all of your money, then you're going to get double tax and you're going to end up paying a little bit more than you would have if you just took it as salary. But again, a savvy accountant is going to help you not do that.
Thank you, Dr. Jaffer, for clarifying those pros and cons. The next question I have is for Dr. Pandey. Can you expand on opportunities for cardiologists to invest or diversify their income streams beyond their medical practice?
Thank you for that question. I'm actually going to back up a little bit and just extend what Dr. Dulay had said. I think, making sure when you're setting up your practice and, hiring staff and things that you have a good contract, that's actually really important. It can really come back to bite you because things can be very unpredictable. We just went through the pandemic, right? So many people had to put, practices were really ramped down. Staff had to be either put on, hold, or their hours were being cut and things like that. And there were people that faced, legal consequences from that. And so having a contract that stipulates various aspects of the potentials for people that you employ, I think is really important. And so, getting someone, it might cost a little bit at the beginning to get someone to draft a legally appropriate contract, but it can really be protective because life is not predictable and things can happen. You might be sick for a bit. You might need to cut down your practice. You might be injured. Another pandemic could happen. Anything can happen where, practices can change transiently. And unless it's stipulated that your staff, can be put on furlough or their hours can be reduced or under different circumstances, or how structures can change if your own practice changes and you need to change the type of staff you have. You don't want to end up having to continue to pay people that you're really not employing in a full capacity, or end up with lawsuits and things that can could become really problematic. So I echo what Dr. DeLay was saying, that I think it's really essential when you're hiring staff that you really think that through properly, and getting a little bit of mentorship from either colleagues that have some experience with it, or getting some professional input might be helpful. And in terms of revenue streams beyond medicine, I think that's a challenge, right? We are very busy as physicians. I don't think many of us have a lot of bandwidth beyond that to be doing a lot else. But certainly, there are ways that you can put your money to work that can be by help to grow your financial stability. And Dr. Jaffer talked about the incorporation. Well, incorporation, both is a good way to try to build assets in a somewhat more tax protected manner, but also ways that you can invest and add revenue streams beyond medicine. So that corporation can be investing in other things. You can have a bit of a layered corporation approach where you can have holding companies beyond that money can move up to. And medical professional corporations can't do anything other than provide medical care and earn through medical care. But if you have holding companies above that, then you can move money up to the holding company, and those companies can do other things. And so it's one of those things that at the beginning, when you first start your medical career, as I think both Dr. DeLay and Dr. Jaffer said, it can be a little overwhelming, right? You've got all sorts of debt. You're trying to just make ends meet. You've got family commitments, life commitments, and it can be a bit daunting that, oh my God, and you're working all the time. How am I going to pay all this stuff off? You will. We are fortunate that we're in a profession that hopefully will never be unemployed, and ChatGPT probably will not replace me. But as long as it doesn't, I have some job security. So if that's the case, then you have to think through. You have a long time window, and don't get overwhelmed by the initial costs that you face. You'll get past that, and then there will be opportunities to really grow your financial wealth. And that's where I think, again, as circumstances change and your financial situation changes, having appropriate professional guidance to say, what should be in a professional corporation? Is it time to start thinking beyond an RRSP to think about a personalized pension plan, an IPP? There are ways that, for example, you can use insurance as an investment vehicle. So not only does it protect your family and your children and others, but then it can also be a way that financial wealth can grow within insured products. So there's definitely different strategies to deploy. And I think it depends on what stage you are in your career and what your financial stability situation is, how you would deploy that.
Thank you very much, Dr. Pandey, for all of these valued tips. And now with our final question of the night before proceeding to networking with Dr. Jaitka. So what financial resources or professional expertise are available to help future cardiologists or cardiac surgeons with financial planning and management?
Sure. I think the one thing that's it's a resource in a way because actually a salary. So when
I'm not sure if I'm the only one, but we don't hear you very well, Dr. Jaitka. It's like okay, so I'm not the only one. Okay.
Can you hear me better now?
Yes, a bit better. Yeah.
It's breaking up a little bit.
Oh, is it? Interesting. I'm not sure if it's my Wi-Fi.
No, it's much better.
That's
much
okay.
better.
Now. That's better.
Okay, all right. So
good.
just the hotspot. So the main tip I'll just get kind of to the point is that cardiology training is very long. It's you do 3 years, which is longer than all the other internal medicine specialties, and then you do fellowships, which is kind of 1, 2, 3 years. But I think some you almost forget that like you're an internist, you're an independent licensed physician. So I think one of the key resources, which is a bit of a touchy subject, is that if you have the energy and your program is on board, to consider locuming, because as a physician, the only way to kind of bring in more money, other than what Dr. Pandey mentioned, investments and other things, is to work more. So there's I have a lot of colleagues, almost all of my colleagues in cardiology training, they locumed. It did not influence like their cardiology training. They still studied. They still were like, very supportive in trading calls, stuff like that. But it's something to consider. I think that had a lot of benefits. And you can do it in a very small scale, where you do, for example, like an overnight shift once every other month, or some people do it more commonly. And I think it gives you a lot of different things. One, it teaches you kind of about the real world practice. How is it to bill? You get kind of practice. So you kind of like fumble on these mistakes in training versus as a new staff, where you've gone 6 months and you realize, oh, you forgot to bill all these codes, and that's like maybe a certain amount of your billing. And then two, it kind of gives you a lot of practice in terms when you do start doing clinic and locums as a staff, you're not just kind of overwhelmed with so many new things. So I would highly advise people, make sure your program's okay with it. Not that I think you could do it anyways, but it's good practice to do that. Talk to your colleagues, find things locally. There's things everywhere. And consider some locums. For most people, hospital based is probably better because not as much follow-up. But some people did clinic locums, and you can see patients longitudinally as well. So that's one kind of tip to consider in training. The other is, I think it's helpful to kind of be very careful with the kind of the team you bring on for your financial goals. There's kind of I was alluding to before, when you start training, there's lots of seminars with all these financial planners and different people who want to sell you insurance products and different things. You want to be careful. This is another way you want to talk to your colleagues. Like, for example, I had success in certain things. I didn't really think that having a healthcare specific accountant would be so valuable, but really I think you need a healthcare focused accountant, not just a regular person, because our needs are very specific. So talk to your friends. A lot of accountants will do taxes for free in residency with hopes that you will continue on. So you can kind of be in that role of a healthcare accounting. They may not focus on you as much, but our taxes are very basic, and you're kind of in that role, and they'll do your taxes for free. The other thing that I've had less success is that I've was kind of roped into kind of family friend insurance packages, and so now it's like I'm in a kind of a situation where I want to have my own autonomy, but you're kind of roped into this other kind of relationship. So those are things that I think you're going to be very kind of careful about thinking about, is who you kind of bring onto your team. Whereas for me now, I have a new insurance broker who's very helpful. I can chat with. I'm with RBC, kind of the private banking that they offer for free. So there's all these kind of tools I kind of offer. And as long as you don't have to pay for things and they give you information, you just got to be very careful with what comes with what. So just be kind of your own kind of advocate. Look out there, try to figure out who you want to bring onto your financial team, because there's a lot of things that we can't know and we need to outsource. You can't do everything. I mean, we can all buy index funds, but that's kind of, but then there's a lot of other things that we need kind of experts to do. So that's one of my last tip is consider locuming, and really be very careful about who you bring onto your financial team.
All right. Thank you very much, Dr. Jaitke, for all of these tips. I think most of us will greatly benefit from them in our future practice. So now we've ended our first part. So now on to the second part of the night. So the networking event. So now we can proceed. Milan, I don't know if you will divide groups or you will do things like that.
No, so everybody will be free to go to the table they want to go at just by double clicking on a virtual chair. So enjoy the networking part.